Welcome back to Financial Independence 101. My name is Mike, and today I'm going to tell you how I am going to pay $0 in income tax for 2020. And yes, I'm the guy that used to have to pay $30,000 a year to pay in taxes, and it ate me up alive. It killed me. But I'm making some sacrifices in my life. I'm making some changes. I'm doing something different. And guess what? It might only happen for 2020. This might be the only year I can do this. And I'm going to tell you how. Coming up. Now, before I go any further, I do want to say these things are things I'm doing. These are tactics I'm using. They're all legal tactics, and it's just written into the tax code, and it's what I'm utilizing. But the reality of this is some of this might not be for you. And actually, there's one big point that probably won't be for most people. But the reality of it is that it's for me. It's what I'm doing. If you use any of my tactics, make sure you consult a tax professional, because that's just the way it is. So anyway, moving into this, the first point that I want to discuss in all of this is tax deferred accounts. Now, I have a IRA, it's a rollover IRA that I rolled three of my 401ks into, and I also contribute to it every single year. So one of the first things that I do is I make sure that my highest earning investments are in that account. So that account grows tax-free. So if you have an account like that and it's growing tax-free, I put my highest earning investments in there. Now, of course, all of those are FDIC insured, which of course we'll have a video talking about FDIC eventually, but those are FDIC insured, so therefore they're very, very safe, because if you lose money in that account, you've lost that money. Like, you absolutely cannot claim that on your taxes as a loss. So you need to make sure you're putting very, very safe investments in there, but also I have safe and high yielding investments all at the same time, and we can get into that investment strategy later. So that's the first thing I do. So the majority of the money that I make for the year is tax deferred. I don't have to pay taxes on that. That's step number one. The second thing is the investment income that I get and I receive is, I don't have to pay Social Security, I don't have to pay Medicare, so it's not taxable in that form, in that matter, and so Social Security and Medicare doesn't come out of that. So that is one really good thing that I'm excited about. So that's the mass majority of the bulk, which will come to about $10,000 that I'm making that's taxable. So on the outside of my tax deferred account, my IRA is about $10,000 worth of earnings. And so with that, I put my lower investment, my lower return, stuff that I need to get to the money quicker and sooner and easier. So that is kind of one of my strategies. Now, in my mind, my whole life, I've had this mindset. So when I retire, which has now been 2 years, don't spend the principal. That's number one principle. Don't spend your principal. So I don't want to drop below my principal amount at all throughout the year. And I'm going to do that through budgeting. And I'm going to talk about more of this here in just a little bit, but the outside money you have to live on. Now, I'm actually going to tap into some of the principal from the outside, and those investments are low return investments, so I'm not really losing out on a whole lot, but I'm reinvesting into higher return investments in my tax deferred account. And of course, I can continue doing this. What's the long-term viability of this? Hey, maybe I can only do this for 2020 for tax purposes, but will I be able to sustain life long-term, spending money that's on the outside when I can't get to that money that's in the 401k for another 25 years or so? So what exactly does all this mean? Well, I actually have one more form of income I want to talk about real fast before I get into a numerical example, because I think you really have to show things with numbers. So I make about $6,000 on my other YouTube channel a year. I've only made $4,000 last year, and I extrapolated about $6,000 for this year. It's a very niche market. I don't see it, even though it's growing, I don't see it growing to the level that it's going to do like 10, 12, 15,000 or anything like that. And you might be saying, Mike, why are you admitting you make so little on your YouTube channel? Because I do that one for fun. Really wasn't for money, but it's kind of nice, and I do spend quite a bit on the channel, so it's fun, and it sort of doesn't even pay for itself, doesn't even pay for half of itself. But in the end, I could even go even further, deducting every expense, but that's really a waste of time because I'm not gonna pay taxes on this stuff anyway. So let's get into the example now. Now, for this example, what I want to show is that I'm gonna make $10,000 in interest and dividends, $6,000 off YouTube, a total of $16,000 in income. And so that's all that's going to get taxed, and that's the only thing that's showing up taxable. Now, how is that? Because the rest of the money that I earn is going to be in a tax deferred account. I've already explained that, but we're looking at what are we going to put on our tax return for 2020, and that is what this is. That's $16,000 showing up right there. That's what's going to be on the tax return. That's what we're going to have to work with. So here's the example for just me. If I were making $16,000 that's taxable, minus my standard deduction of $12,000 in standard deduction, I end up having 2 kids that I could deduct roughly $4,000. I would be paying nothing. Nothing in income because of the fact that, well, the income is so low. I have sheltered the rest of my income, tax sheltered legally. I've been working on this for a long time. And so you're thinking, okay, so if I'm single, I make 30, 40, 60, 80, 100,000 a year. How can any of this help me? Well, guess what? This can help you if you make 100,000 a year. You can put $17 or $18,000 in your 401k. You can put $6,000 in your IRA, which, by the way, I'm going to show you when I add my wife into the equation. We will have to use that, but you can put that in there. You could shelter that much money, depending on your income levels. Now, if your income is too high, you can still do your 401k, but you can't do the IRA contribution. And of course, I don't use Roth, and I've discussed that. We're going to get more on that in this next. So I'm sure you're going to be wondering, Mike, how are you going to live any kind of a lifestyle with that little bit of money coming in? And I budgeted to spend about $20,000 for myself. And actually with my wife, she's going to make about $20,000. And I'm going to show you that in the next example here, how we're going to tax-free still. But looking at that, we're going to spend about $40,000 this year. And spending $40,000 is an extremely good lifestyle if you have no house payment, no car payment, no consumer debt, no, a student loan debt, none of this other debt, no debt whatsoever. The only debt we have is what we run up on the credit card. And guess what? We pay that credit card off every month. I have spent this much interest on credit card interest. I plan to spend this much on credit card interest. I don't ever expect to spend a penny in credit card interest or any other interest. We only spend money on stuff that makes us happy and helps enrich our life and enjoy life. And the reality of $40,000, heck, if I needed to, I could cut it to live off of 10. I could live off of 10 in 2020 if I needed to. But hey, where's the fun in that? Why work 24 years, 70 to 90 hours a week? Why save all this money and invest to live that kind of lifestyle? That's a big question. People are thinking, well, how are you going to make it off of such low amount of money? We're actually living very, very large in my state, in Oklahoma, living very large off of $40,000 a year. All right, so for this next example here, I'm going to show you my wife's income getting introduced into this. So I'm going to have $16,000 that's taxable. She's going to have about $20,000 that's taxable from her job. And now, looking at this, we're both 6-figure earners that took our incomes down into either retirement, or for her, she didn't want to retire. She wanted to work just a real part-time job, make very little money, which I actually think she's paid very well for the little bit of time that she puts in. So when you look at this, we're going to have a total of $36,000 in actual taxable income. Now, that's taxable income, okay, so we're going to talk about how we can shelter this taxable income, and how $36,000, if you are a married family of 4 and you're married filing jointly, I'm going to show you how if you make $36,000 a year, you should have a 0 tax liability if that's your total household income. So first of all, your standard deduction on there is $24,000. So your standard deduction is going to take out the majority of your earnings. So heck, you don't have to pay no taxes on that. It's 0 taxes. Don't have to pay don't have to pay any. Now, again, I'm just throwing in $4,000 that will get me credits for the kids. So the reality of that is, I haven't dug that deep into it. In fact, I used to do all my tax returns by hand, but nowadays I don't do them by hand for fear of audit. That is the number one reason I don't do it by hand. I know that they do have their own red flag system, and I think doing them by hand is a red flag system this day and age. And the other reason is I do like the quick, fast easiness of the electronic filing. And of course, I do my taxes for free. So the next thing, the total tax liability appears to be $8,000. So you look at this and you go, okay, 36 minus 24, and then minus 4 is 8, right? So it looks as though we're going to have $8,000 in tax liability, but we're not really going to have $8,000 in tax liability. What we're really going to have is 0. And here's why. The IRA contributions for the year. Now, I've always been an IRA contributor, but I only contribute what takes off my tax liability. I don't contribute to an IRA one extra dollar. I play with that number to see exactly how much I contribute. And there were a couple years I made so much I couldn't contribute. I didn't contribute anything. And I know the people with the Roth IRA mentality contribute as much as they can to the Roth because they're thinking that, you know, they'll be making $2 billion a year when they retire, so they don't want to pay taxes on it when they retire. Versus me, this is how I view my retirement. Fully tax deferred. But anyway, I'm still making contributions. I can't touch this money for another 20-something years. Well, actually, 19 years I could touch it, but I don't want to plan to touch it for about 25. So for that, I don't want to overload too much of my assets and too much of my money into my IRA. So that's why I'm doing it like this. Now, the reality of it is that there is one thing that I'm not talking about, and at that $6,000 that I'm making and the $20,000 my wife makes, so the YouTube money is going to be, I haven't incorporated, I haven't started an S Corp or an LLC or any of that kind of stuff yet, because of course on YouTube I'm not that big of a presence, not big of a deal. But the reality of it is I haven't done that yet. I'll probably need to do that for next year, and that'll probably save me a lot of money next year. And with my wife though, we're both going to have to pay Social Security and Medicare, which to me, I don't count on Social Security. If you can see, I'm retired now, and what percentage of Social Security have I planned for? I'll let you figure that one out on your own. I hope you found some of this to be helpful, if not at least a little bit entertaining. I'm going to come back with a whole bunch more videos with life hacks, teaching you how to save money, invest money, become financially independent such as myself. Like, subscribe, and Financial Independence 101 out.